Investing your money is great. You can get to make more money. You get to make more returns on your money. You get to beat inflation, and it's usually a better way to store money than to just have it in a savings account at the bank. Now, investing with borrowed money is also great if the returns on your investments are good or your investments do really well. However, on the flip side, if you suffer any losses on your investments, then that debt or leverage will become a burden for you. Now, any investment is risky, but if you use debt or leverage to invest, then you're adding more risk to your investments. And one of the first things that you should do before you invest in anything is to weigh the risk of the investment that you plan to get into. Now, this is why it is recommended that people only invest sums of money that they can afford to lose comfortably and not just invest all the money they have saved up, put their house on the market, sell their cars, and invest all they have. So in this video, I'll be explaining the risks associated with borrowed money or leverage to invest, and this way you guys can have a good idea if this is something that you should be doing or not. Now, before I get into all the details here, just a very quick reminder, welcome back to the channel if you are already a subscriber. And if you're new here and seeing me for the very first time, my name is Eann, and on this channel, I talk about ways to make money, ways to save money, ways to invest your money, credit cards, banking apps, and everything that has to do with personal finance. So if you like these videos and these types of topics, be sure to give this video a thumbs up. I'll really appreciate it. It's 100% free to give this video a thumbs up. And also consider subscribing to the channel and turning on all notifications. And that way you'll never miss the updates of when I post new videos on this channel, which is every single day. Now back to leverage or leverage and investments. So there are actually some people who don't believe in using their money or their own saved money or earned money to invest. Instead, they believe in only borrowing money from the bank and then using that money to invest, and then that way they get returns on the money that they borrowed. They pay that debt off, they keep the profits, and that's very good. Now, this is actually a very good strategy if everything goes well. And a very good example of this would be real estate. So this strategy of using debt to invest seems to work really well with real estate, or has been working for real estate for at least the past 100 years. So for a quick example, let's say you borrowed $300,000 from the bank and you bought a fourplex in 1995. You then rented this fourplex, and over 26 years after servicing the debt, paying your property taxes and insurance, and all other costs associated, you profited $20,000 per year on this investment. This means every single month you made a profit of around $1,666 on this fourplex after collecting rent and taking care of all the expenses. This means that today you would have made around $520,000 from that investment with all expenses already paid. Now, in this case, borrowing money for that investment would have been a very good idea because you have profited greatly from borrowing this money. Now, in this example, you have that $500,000 from rent payments over the past 26 years, but you also have the appreciation of the property and also inflation working in your favor. So for real estate in the year 1995, whatever you could purchase with $3, you now need $5.56 to purchase the exact same thing. And I'll leave a link below to where I got the calculation for this. Now, this means that the property is now worth at least 40% more than what it was worth when you purchased it. And then this is just looking at inflation and not necessarily the appreciation of the property and any upgrades that you may have done to the property over the past 26 years. So if you were to sell that property right now, today, you could list it for about $450,000. You could sell it, and you also have that $500,000 or $520,000 that you made from the property over the last 26 years. So with all expenses paid, you would have profited almost $1 million from this investment. So that's the way the debt or leveraged investments work. You can use that as a tool, or you can use debt as a tool to invest, and you can make a lot of money. However, the problem comes in because in the good years when your investment increases in value, then the debt actually increases the amount of money you make because you were able to invest more money upfront. However, in the years when your investment doesn't do really well or actually goes in the negative, then those are the years where you'll be left with the bill, the interest payments, and no returns. So leverage can increase your earnings, and it can also increase your losses. Now, with all investments, if you borrow money or if you use leverage, it doesn't really matter. You still have to repay the debt whether you are making good returns on your investment or not. So this is where you have to draw the line between actually investing and gambling. Now, in the real estate example I just went through, if you were to borrow money and purchase a house and then you got some tenants and they weren't the best and they damaged the property somehow and you didn't have any money to repair it and the property also went down in value, you could actually still sell that property, but you would need to pay the bank the full amount that you borrowed. So in this case, you'd probably lose 10% or thereabout of your money, which isn't all that bad. However, that's with real estate. The other example where this could be worse and become a nightmare for you is if you use a brokerage account with leverage. So let's say you have this brokerage account and you have $100,000 invested in some stocks or ETFs or bonds. Your brokerage decides to offer you a margin and then you borrow, or you can borrow up to 50% off your investment amount. So this means that you can borrow up to $50,000 to invest. You then borrow this $50,000 and you purchase 1,000 shares of a stock at $50 per share. So now the balance on your brokerage account or the balance in your investment is at $150,000. However, let's say a month from this, the value of the stock that you purchased for $50 per share goes down to $35. This now means that the value of your investment is now at $135,000 and no longer at $150,000. Now, if this is actually a good stock and a good company, you could hold on to the stock and you could wait this out and maybe you'll become profitable, which is good. However, the problem here comes in because most brokerages have a certain number or amount that you have to maintain if you're using leverage. So for example, maybe the brokerage has a rule that says if you use leverage, you have to maintain a 50% margin at maximum. So now you're down to 35% and the brokerage can do one of two things. This is why it's also very important to research the brokerage you use before you invest, so you know beforehand what they will require if you plan on using leverage. So the first thing that they can do here is they can ask you, or they can actually force you to deposit money into your investment account to bring your balance back up to the amount which would take you back to a 50% margin. And you don't necessarily have to invest this money in your portfolio, but you can just have it in your investment account and that way they are covered. However, some other brokerages will actually require that you sell the stock or sell stocks in your investment portfolio to cover the margin. If this is the case, then you stand to lose money here because now you have to sell your investments at the worst possible time when they have lost a lot of value and the stocks have gone down. And if you were using your own money to invest, then you would be purchasing more stock at this time. But now you have to sell stocks to cover for the losses, and you don't really have a choice because you're going to be forced to do so. So these are two examples where you could use debt to invest, and in one you're profitable and you make a lot of money, and the second one is where you stand to lose a lot of money if your investments dip. Now, this doesn't mean that you still can't use leverage, but you should use a leverage only when you can afford to take the risk that come with using leverage, especially with brokerage accounts. So if I were to use leverage in my brokerage account, I would use the maximum amount, or I wouldn't use the maximum amount of leverage extended to me. So for example, if you use the M1 Finance platform, you get to use about 35% in leverage. So instead of using all 35%, you could use only 20. And that way, if your investments fluctuate and they go down in value a little, then you don't really have to do anything. You can wait it out. And once the investments go back up in value, you make money. Now, if you exhaust your leverage and the investments lose a lot of value, then you may be forced to take a loss, which is definitely not what you want to do when you're investing. So consider this before you use leverage to invest again. Comment below and let me know if you've ever used leverage in your brokerage account or if you plan on using leverage to make any other investments. Let me know if you made money using leverage and if you'll continue to use leverage to invest. As always, I hope this video was very helpful and it gets you to understand the risk involved with using leverage to invest, especially when you're using a brokerage account to invest. If you found this video helpful, be sure to give it a thumbs up. I'll really appreciate it. And also subscribe to the channel and turn on all notifications. And I'm also going to be leaving a couple links down below to free stuff, which includes a link to M1 Finance, my favorite investment platform and app, and also WEBULL, where you can get involved in stocks and investing, and you'll either get free cash or free stocks when you use the links down below to sign up. As always, Thanks for watching, and I'll see you guys tomorrow in the next one.